Welcome to Stock Talk with Nico Criticos. Today we're going to be going through Walgreens stock and CVS stock and doing a comparison to see which one is a better buy. And I'm going to give you my opinion on both of them. However, I'm not a financial advisor, so please do your own research. But with that said, I've made a chart here that compares all the different important things for both stocks, and we're going to figure out which one is a better company. So right off the bat, Walgreens and CVS are two of the largest pharmacy companies in the country and around the world. And CVS is the larger one with a market cap of $109 billion. Walgreens has a $41 billion market cap. Next up, we have prescription market share. CVS owns 25% of prescription market share, and Walgreens owns 19%. So CVS is a bit bigger than Walgreens. And I believe CVS has 10,000 stores and Walgreens has 9,000 stores. The revenue for 2020, Walgreens did $139 billion, which was up 2% from 2019. And CVS did $268 billion, which was up 4.6% year over year. Then for 2020 earnings, Walgreens did $456 million, which was down 88%. And if we go and look through this, we can see on their income statement. I was trying to figure out how this happened, and I read some reports that said it was really because of supply chain issues. It was because of people buying lower margin items, and then they were paying more for employees. And I mean, that doesn't seem like enough to make that big of a difference, because CVS pretty much has the exact same business, and their earnings for 2020 were up 8%, and CVS did $7.1 billion. So, and if we go to their income statement here, we can see that, let's see, you pretty much break, if you go to cost of revenue, you can see that the cost of revenue for at the end of 2020 went to 29 million. And so it went up a little bit, but still that doesn't explain much. But with that aside, normally Walgreens does fine. Their earnings are normally in the, let's see, if we go down here, we can see so in 2020, their earnings were 456 million, but normally they're around 4 to 5 billion. And for this year, they've been doing about the past 2 quarters, they did a little over $1 billion per quarter. So they seem to be back on track. Then moving on, we have the 5-year performance of the stock, and Walgreens is down 40% over the past 5 years, and CVS is down 4% over the past 5 years. And so really both of those are poorly performing stocks. Neither of those numbers are good. Then if we go on, we can see that their dividend ratio, dividend for Walgreens is 4%, dividend for CVS is 2.3%. However, Walgreens is paying nearly twice as much as CVS as far as the payout ratio goes. Walgreens has a 72% payout ratio and CVS has a 36%. So CVS is technically in a better spot there. Then we have return on capital. Walgreens did 4.8%, CVS did 9%. Return on equity, Walgreens did 10% and CVS also did 10%. Then we go to the management and we look at, in 2021, both companies got new CEOs, and Walgreens got Rosalind Brewer, who was prior the COO of Starbucks. And then before that, she was the CEO of Sam's Club. So she has lots of experience working at big companies and she has a great track record. Then we have, for CVS, we have Karen Lynch, and she has been working at CVS for, I want to say, since 2015 or so. So she has years of experience at CVS. And I listened to interviews with both CEOs, and they both sound intelligent and they sound like they know what they're talking about. So both CEOs are good. Then we have valuation of a forward PE of 9 on Walgreens and a forward PE of 10 on CVS, which are both cheap, fairly, those are fairly valued companies. And then profit margin of 1.6% for Walgreens and a profit margin of 2.6% for CVS. Keep in mind, these business models are low margin businesses that really make their money through volume, high volume, low margin. So that's traditionally, those are not good numbers, but that's just the type of business they're in. That's how it's going to be. Then we have balance sheet. And if we look at the Walgreens balance sheet, I put A because over the past couple of years, we can actually see that their total equity has been decreasing. From 2018, it went from 26 billion. To 2020, it went to 21 billion. Luckily, now it's starting to move back up and we're at 22.5 billion off of the last quarter. But if you compare that to CVS, you can see that CVS has done much better with their performance. In 2017, CVS had equity of 37 billion, and today they have equity of 73 billion. So they've been growing it all along. And the other thing, now here's the other thing to look out for though. This has not been reported on the balance sheet yet because they did this deal in June. And so this should be coming out within the next couple of weeks on the balance sheet. Walgreens sold their Boots Alliance investment for $6.5 billion. Okay, so they're going to get $6.5 billion added to their balance sheet. And they say they're going to use that to pay off their long-term debt, as well as invest into new retail pharmacy stores and their healthcare business. So that's an extremely positive thing there. Now, if we go through all these metrics, we say, okay, CVS has had a better balance sheet over the last couple of years. They have a better profit margin. Forward PE is not much different. They both have great management. They both have the same return on equity. Their return on capital, CVS has a better return on capital. Walgreens does pay a higher dividend, but CVS is in a healthier spot as far as what % of their earnings are going to a dividend. And then the 5-year performance, CVS is better, although both of them are bad. And if you look at it from the perspective of which one are you getting at a better deal, it almost seems like Walgreens is a better deal because it's fallen so much. Then we have their earnings. We see that CVS put up positive numbers in 2020, and Walgreens decreased in earnings, so that's not good. And then we also have that CVS is the leader in this market with the most amount of market share, and the fact that their market cap is almost 3 times the size of Walgreens. So based on all these things, it looks like CVS is the better run company, and so it would make more sense to buy CVS. However, here's the thing. I own 90 shares of Walgreens and 0 shares of CVS. So I believe that at this time, Walgreens is actually the better buy. And this is just because the stock has gone down so much and because the dividend is twice as high. The main reason I'm buying this is not because of, I believe the stock is going to skyrocket, but it's because of the safety of the stock as well as the high dividend that it pays. So that's why I'm in Walgreens. But to be honest, both companies are safe companies. They're both pretty well run. They both have good management. They're both trading at cheap valuations. So I can't really say anything too bad about either one. So both of them are strong companies and both of them would probably be a good investment.